90 days, 27 iron condors. And I tracked every single one of them: entry price, exit price, IV rank at open, days to expiration, max profit, max loss, whether I adjusted, whether I should have adjusted, all of it. Every trade logged. And what I found was not what I expected going in. Some of what the data showed confirmed things I already believed about this strategy. Some of it completely changed how I trade iron condors, and a few of the numbers were honestly uncomfortable to look at. That's what this video is. A full, honest, data-driven review of 90 days running iron condors as a core strategy. No cherry picking, no highlight reel, just the numbers and what they mean. Let's get into it. Before we look at results, you need to understand the framework, because results without context are meaningless. Every iron condor in this experiment followed the same entry rules. I was selling condors on broad market ETFs and high liquidity underlyings only. No earnings plays, no low volume names. Entry was always between 30 and 45 days to expiration. Short strikes were placed at roughly the 16 delta on each side, targeting one standard deviation away from the current price. Credit received had to meet a minimum threshold relative to the width of the wings. Same rules. Applied consistently across 90 days and 27 trades. That's the baseline. Alright, here's what the data actually showed. Of 27 trades, 19 were closed for a profit. That's a win rate of 70.4%. For reference, theoretical win rate at the 16 delta on each side puts you around 68%, so that's right in line with what the math would predict. No magic, but also no major deviation. Average credit collected per trade, $1.23 per share, or $123 per contract. Average profit on winning trades, $58. That's 47% of max credit, just short of my 50% target, which tells me I was occasionally closing slightly early. Average loss on losing trades, $187, or 152% of the credit received. My losers were on average hitting before my 200% stop, but still significantly larger than my winners. The overall return on capital deployed was 11.3% for the quarter. Annualized, that would be around 45%, but I want to be careful with that number because it assumes conditions stay consistent. They don't. Here's where it gets interesting, because raw win rate and P&L only tell you so much. When I broke the data down by variable, a few things jumped out. Finding 1. IV rank was the strongest predictor. Trades entered when IV rank was above 50 had a win rate of 81%. Trades entered between 30 and 50 IV rank, which is still technically elevated, had a win rate of only 61%. That 20-point difference from a single filter is significant. Finding 2. DTE at entry barely mattered. 30D TE versus 40 to 45 DTE produced nearly identical win rates. The 40 to 45 DTE trades had slightly higher premiums collected, which improves the math, but not enough to be conclusive. Need another 90 days of data before making a firm call here. Finding 3. Adjustments made things worse. Of the 8 losing trades, 5 of them were trades where I made a mid-trade adjustment. In every single case, the adjustment either broke even or made the loss larger. The 3 trades I let hit my stop without adjusting. Those were cleaner, smaller losses. Finding 4. One volatility spike dominated the losses. The 2-week vol spike in month 2 accounted for 71% of total losses across the full 90 days. 2 weeks out of 13 wiped out a significant chunk of what took 11 weeks to build. That's the nature of short premium, and it's why position sizing matters more than almost anything else. So where does all of this leave me on iron condors as a strategy? Still constructive, but with clearer rules. The 70% win rate is real and repeatable, grounded in delta math, not in any special ability to predict price. That part works. What doesn't work is the adjustment protocol. Simplifying it, And the IV rank filter is going up to 45 fewer trades, but the math works out better with higher quality entries. Whether you're already trading iron condors or thinking about it, here are the takeaways that are actually actionable. 1. Be selective about your IV environment. The threshold matters. 30 is probably not high enough. Know your IV rank at entry on every trade and track how your results change across different IV environments. 2. Trust your stops. Adjusting a losing condor feels productive. The data in my journal says it usually isn't, at least not at this level. 3. Volatility spikes will happen. They are not edge cases. Plan for them in advance with position sizing, not in the moment with panic adjustments. 4. 90 days is not enough data to draw final conclusions. 27 trades is a limited sample. These findings are directional, not definitive. The only way to know if these patterns hold is to keep tracking. This kind of analysis is only possible because I tracked everything from day one. Every trade, every variable, every outcome. Without that data, this video would just be me sharing opinions. With it, there's something real to look at and build from. If you're running any kind of systematic options strategy and you're not tracking at this level of detail, you're leaving your most valuable feedback loop on the table. I track all of this using a tool called OptionsPro. It's built specifically for options traders, so the fields I care about, IV rank, delta at entry, strategy type, days to expiration, adjustment history, are already built in. I'm not here to sell you on it, but if building a tracking system from scratch has been the reason you haven't started, it's worth knowing it exists. Link is in the description. If you're running iron condors yourself, drop your win rate in the comments. I'm genuinely curious whether the numbers other people are seeing line up with what I found here. And if you want to follow up at 180 days with double the data, let me know. I'll keep running it. Like the video if it was useful, subscribe if you want more data-driven content like this, and I'll see you in the next one.